Buying a house is one of the biggest financial decisions you'll ever make. It's the American dream, right? But before you sign on that dotted line, let's take a step back and have an honest conversation. Today, I'm breaking down the hard truths about homeownership that most people don't talk about. So grab a coffee, sit back, and let's dive in. You might have heard the saying, a house is an asset. Well, I hate to break it to you, but in many cases, it's actually a liability, especially if you buy it at market highs and/or interest rate highs. An asset puts money into your pocket. A liability takes money out. Your house? It takes money out every month in the form of taxes, insurance, and maintenance. And that's before you even start talking about interest. If you keep your house long-term, then best case scenario, your house is a form of saving money. So I am not saying a house is a bad purchase, I am saying there are some things to consider before you buy a home. Let's talk about amortization. If you take out a 30-year mortgage, you'll spend the first 15 years, yes, half of your loan term, paying mostly interest. Here's how it works. Say you buy a $300,000 house with a 6% interest rate. Your monthly payment would be about $1,800. In the first month, around $1,500 of that goes to interest, and only $300 goes to the principal. After a year, you've paid $21,600, but only about $3,600 has actually reduced your loan balance. Over 15 years, you'll have paid roughly $324,000, but your loan balance has only dropped to around $190,000. That's the power of amortization, and not in a good way. Now you might be thinking, what about refinancing? That'll save me money, right? Not so fast. When you refinance, you're starting the amortization process all over again. Sure, your monthly payment might be lower, but you're resetting the clock on that interest-heavy phase. Let's look at the numbers. If you've paid off $100,000 on your original loan, then refinance the remaining $200,000 into a new 30-year term, you'll pay interest on that $200,000 for another 30 years. Even at a lower rate, you could end up paying tens of thousands more in interest over the life of the loan. And the banks? They know this. That's why they're so eager to offer refinancing. Here's another eye-opener. By the time you pay off a 30-year mortgage, you've likely paid for your house 1.5 times over. Let's break that down. At 6% interest, your total payments over 30 years come to around $647,000. That's more than double the original loan amount. Even if your home appreciates in value, say to $450,000, you're not pocketing as much as you think because a big chunk of that value went straight to interest. Owning a home isn't just about the mortgage. There are hidden costs you need to consider. Property taxes can add thousands to your annual costs. Insurance is non-negotiable. Maintenance and repairs? Expect to spend 1 to 3% of your home's value every year. That's $3,000 to $9,000 annually for a $300,000 home. And if you're in an HOA, add those fees too. It all adds up. Let's talk about a common mistake, letting the bank decide how much house you can afford. Typically the process goes like this. You go to the bank, they look at your income, and they tell you, we'll approve you for $300,000. Excited, you start shopping for a house that costs exactly $300,000. But here's the problem. The bank is deciding for you how much mortgage you can afford, not how much you can truly afford. Yes, you might technically be able to make those monthly payments, but that doesn't mean you can afford the long-term financial strain. Here's a better strategy. Set your own budget first. Factor in your savings, investments, and other financial goals. How much do you need to save for emergencies or retirement? How much do you want to invest in growing your assets? Once you've accounted for those priorities, determine how much you can comfortably allocate to a mortgage. This is where the concept of a cost-benefit ratio comes in. If you stretch your budget to afford a high mortgage payment, you're sacrificing your ability to save, invest, or even have more purchasing power for everyday needs. For example, let's say a $300,000 mortgage costs you $1,800 a month, but a $200,000 mortgage only costs $1,200. That $600 difference could go toward an investment account that grows over time, or it could give you breathing room for unexpected expenses. By setting your own budget instead of letting the bank decide, you take control of your financial future and ensure that your home is a blessing, not a burden. Another critical factor to consider is market fluctuations and interest rate cycles. Real estate markets go through ups and downs, influenced by economic conditions, supply and demand, and interest rates. Here's what you need to know. When interest rates are low, buying might seem more attractive because monthly payments are lower. But this often drives up home prices because more people can afford to buy. On the flip side, when interest rates rise, prices might stabilize or even drop, but your borrowing costs increase. It's a double-edged sword. For example, in a low-rate environment, you might get a 3% interest rate on a $300,000 home, making your monthly payment around $1,265. If rates rise to 6%, that same home would cost you $1,800 per month for the same loan amount. Timing matters, but predicting the market is tricky. Books like The Millionaire Real Estate Investor by Gary Keller and resources like the Federal Reserve's interest rate reports can give you insights into these cycles. The key takeaway? Don't try to time the market perfectly. Instead, focus on buying when it aligns with your financial readiness and long-term goals. Be sure to watch my video on House Hack to turn your house into an asset. Don't forget to like, subscribe, and share for more financial tips.